Welcome back to Dukascopy TV. Now, some wealth managers are urging investors to be careful when considering high-yield corporate bonds for fear that a bubble may exist. Here to discuss this further is Mr. Krief from ODDO Asset Management. Mr. Krief, thank you very much for coming in.
Thank you.
Now, if we look at unprecedented monetary stimulus from central banks, also taking into consideration low interest rates, there is this fear that people are looking for more risky assets to invest in, and there has been some suggestion that perhaps they're not compensating as much as the risk that people are wishing to invest in them. Is this something that you tend to agree with at ODDO at the moment? What is your thoughts on the matter?
Yeah, not exactly. I quite disagree with this point. Why? Because first you have to consider two things. Yield, we are now at an historical low on yield, but not on spread. So you have to consider that. On yield, clearly because of the sovereign debt, and especially German debt, is at a historical low today. So that's why the corporate and all what we have on the high yield credit is, in terms of yield, quite low versus the historical basis. But when you look at spread, it's quite fair priced. So you have to separate, I would say, the two things. And that's why we are focusing on spread, and especially when you go down into the scale of rating, the double B and especially the single B, so high yield, is quite attractive, and still you are very well compensated regarding the risk you have.
Now, there has been a recent report by the S&P lately that European high-yield bonds have fallen by 5% over the last year. However, investors on the whole are seemingly unperturbed by this. Why do you think this is?
Well, the environment has changed a lot. Last year, we have still a systemic risk, really still in the spread, in the value. So anyway, this systemic risk is still there, but is quite low regarding last year. This is why now we are much tighter now and with lowest yield, first of all. And the second thing is that we have a very good performance last year, and we don't expect a 25% return for this year. So regarding that, we are now going to a normalization. So we don't expect 25%, but more 10% on this asset class. So it's true that it's not the same yield, but it's still attractive regarding the rest and the environment.
Now, as you say, still an attractive investment to many. There has been some chat that this bubble, if we will, has been around or has been a risk for quite some time. So it's not exactly new, it's not exactly news. But why is the fear coming to a light now, would you say?
Well, we are always afraid of bubbles because when it explodes, it makes a lot of damage, clearly. But where is the bubble now here for the moment? There's no leverage. Companies are in better shape than before, with a decent balance sheet and much better this year than before. So there's no bubbles because there's no leverage on this asset class. And secondly, as well, what is very important is that the investors has changed. Now the European high yield is much more mature with a 300 billion market. It's much more mature than before. So we tend to be like the US market now with long-term investor, which is very different. So there's no bubble, there's even less bubble than before because of this long-term investor like pension funds, insurance, getting into this asset class.
But you mentioned the falling yields. How substantial has the impact been, and has it made you at ODDO diversify your portfolio, for example?
Yeah, first of all, we have to be very diversified in this asset class because the risk is idiosyncratic. So when you diversify, you minimize your risk overall. So this is the first point. The second point is the impact of the risk-free rate, what we call the risk-free rate. So for example, German bonds, the impact of any raise in rates for high yield. This impact is quite low. These two asset classes are negatively correlated first. So and also the part of the risk-free rate into the total yield for high yield bond is very low. So the impact will be negligible.
Now, it sounds like, as you're saying, the impact is negligible. The other advisors are also saying there's no need to completely eliminate high yield bonds. Is flexibility at this particular difficult time key here, would you say?
Well, now, like I said, the high yield is viewed as a long-term asset class investing. This is a change in our market, in the European market especially. So that's why it's still interesting. Now, regarding the yield we have, the high yield, like I said, will be not so much impacted in when you go down to the scale of rating, even no impact if any movement in risk-free rate. And the credit and the situation of the company, of all the companies we are investing in, like I said, they are in good shape. So, of course, it's still a very good asset class to invest. So, still very attractive. That's why, for example, in the diversified portfolio, high yield has to be there. Because over a long term, now the investors can see the performance of a long-term period that high yield even overperform equity or government bonds on a 10 years basis, for example.
Thank you so much for your insights today. It sounds attractive and still worth investing in. Thank you. It's great to hear. Thank
you very much.
Well, that's all from Mr. Krief and myself for the moment. Click back for all the hourly updates on FX, but for now, goodbye.